Please subscribe to our channel. Our subscribers mean so much to us. Consider clicking the thumbs up and commenting on where you're watching from and what kind of videos you'd like to see from us. American Northwest Magazine. Share this video with others who would like to understand these basic economic principles and definitions. And don't forget to click on the notification bell. The US money supply is a complex beast. We measure it using something called money aggregates. These aggregates M1, M2, and M3 help us understand how much money is sloshing around in the economy. M1 represents the most liquid forms of money. Think cash in your pocket and money in checking accounts. This is the money readily available for spending. M2 includes everything in M1, but it also adds in things like savings deposits under $100,000 in money market mutual funds. These are slightly less liquid but still relatively easy to convert to cash. M3 is the broadest measure. It encompasses M2 plus large time deposits held in banks. Think certificates of deposit, or CDs. These funds are less liquid and typically have restrictions on withdrawals.
Section 2. Liquidity, the flow of money. Liquidity refers to how easily an asset can be converted into cash without affecting its price. Think of it as the ease of flow for money within the economy. M1 represents the highest level of liquidity. It consists of assets readily available for transactions. M2 is less liquid as it includes assets that may take a bit longer to convert to cash. M3 is the least liquid of the three. It includes assets that may have penalties or time restrictions for withdrawal. Understanding these measures helps investors gauge the amount of money available for spending and investment, influencing asset prices and economic growth.
Section 3. The 4-year liquidity cycle and elections. Believe it or not, there's a cycle to how much money is available. We call it the 4-year liquidity cycle. It's like clockwork, and it's tied to elections. In the year leading up to a presidential election, governments often increase spending. This pumps money into the economy, boosting liquidity. Why? Because a little economic sugar rush can help sway voters. This surge in liquidity can lead to increased investment and economic activity. However, it can also contribute to inflation if not managed carefully.
Section 4. Interest rates. A key driver of liquidity. Interest rates are like the volume knob for liquidity. When the Federal Reserve, our central bank, lowers interest rates, it becomes cheaper to borrow money. Lower interest rates encourage businesses and consumers to take out loans and spend more. This increases the money supply and boosts liquidity. Conversely, when the Fed raises interest rates, borrowing becomes more expensive. This can slow down economic activity and reduce liquidity as businesses and consumers tighten their belts. Understanding the relationship between interest rates and liquidity is crucial for investors to navigate market fluctuations.
Section 5. The Treasury's role in liquidity management. The U.S. Treasury plays a vital role in managing liquidity. They issue bonds to finance government spending, but they also buy and sell these bonds in the open market. When the Treasury buys back its bonds, it injects money back into the system. This increases liquidity, making it easier for businesses and consumers to borrow and spend. Conversely, when the Treasury sells bonds, it pulls money out of the economy. This decreases liquidity, potentially slowing down inflation. The Treasury's actions, alongside the Fed's monetary policy, work in tandem to maintain a balance between economic growth and price stability.
Section 6. Inflation and the Fed's Balancing Act. Inflation, the rate at which prices increase over time, is heavily influenced by liquidity. When too much money chases too few goods, prices rise. The Federal Reserve keeps a watchful eye on inflation. They use monetary policy tools, like adjusting interest rates and reserve requirements for banks, to control the money supply and keep inflation in check. If inflation gets too high, the Fed might raise interest rates or sell bonds to reduce liquidity. This can help cool down the economy and stabilize prices. The Fed's Balancing Act aims to maintain a healthy level of economic growth without letting inflation spiral out of control.
Section 7. Liquidity's impact on assets, stocks, housing, and cryptocurrencies. High liquidity can be a boon for asset prices. When there's plenty of money flowing around, investors are more likely to put their capital to work, driving up demand for stocks, real estate, and yes, even cryptocurrencies. A surge in liquidity can push stock prices higher as investors seek returns in a growing economy. Similarly, increased liquidity can lead to a hot housing market, with low interest rates fueling demand and pushing up property values. Cryptocurrencies, particularly Bitcoin, have also shown sensitivity to liquidity. As institutional investors and corporations have entered the crypto space, Bitcoin has increasingly become correlated with risk assets, benefiting from periods of high liquidity.
Section 8. Lynn Alden's insights on Bitcoin and liquidity. Lynn Alden, a prominent macroeconomist and Bitcoin advocate, offers a compelling perspective on the relationship between Bitcoin and liquidity. Alden argues that Bitcoin, with its fixed supply and decentralized nature, acts as a hedge against fiat currency devaluation, especially during periods of excessive liquidity creation. She emphasizes that central banks often respond to economic downturns by injecting liquidity into the system. While this can provide a short-term boost, it also devalues fiat currencies over time. Alden posits that Bitcoin, with its scarcity and resistance to inflationary pressures, stands to benefit as investors seek alternative stores of value during periods of monetary expansion. Section 9. The current liquidity landscape and Bitcoin's potential. We're in a fascinating time. Governments and central banks have pumped trillions of dollars into the global economy in recent years. This has created a highly liquid environment. While this has supported asset prices in the short term, it has also raised concerns about inflation and the potential for a bubble. In this environment, Bitcoin's value proposition as a hedge against inflation and a store of value becomes increasingly relevant. As we move further into the 4-year liquidity cycle, understanding the interplay between monetary policy, liquidity, and asset prices will be crucial for investors seeking to navigate the markets effectively.
Section 10. Join the discussion. We need to hear from you. Hit that subscribe button below and ring the bell so you never miss an update. Give this video a thumbs up if you found it informative, and share it with your friends so they can join the conversation too. Let me know in the comments what you think about the current liquidity environment and its potential impact on Bitcoin. Are we headed for a boom or a bust? Share your thoughts, and don't forget to tell me where you're watching from. Your engagement keeps this channel going, and we appreciate each and every one of you. Remember, knowledge is power, and together we can make smarter investment decisions.